Hello, am I audible? Can you see my screen? Okay. All right. So we have been discussing the different cycles, right? We talked about the revenue cycle and expenditure cycles, and what is your responsibility as an auditor when you're testing those cycles? Uh, Again, revenue cycle is one of the most important cycle in any business, and same for expenditure cycle, but it's just the opposite of revenue cycle, right? Uh, we will talk about cash cycle today and some other cycles as well. So when it comes to cash cycle, right? So there are two main concepts in cash cycle which you should be aware of. One of which I already talked about when we were discussing the revenue cycle. So that is called lapping. Now, what is lapping? Again, simple example. Let's say customer A pays us $1,000, right? So A is our customer who pays us $1,000. So accounts receivable, we are getting the payment from accounts receivable. Now the employee who handles the payment, so that employee steals this cash instead of recording it. And this could have happened because there was no segregation of duty, maybe. So the employee who was responsible for the custody of cash was also responsible for recording it, right? So as a result of which, this employee got this cash from this customer, but he or she did not record it, right? So this $1,000 got pocketed by this employee, right? Now, let's say customer B later pays $1,500, right? Now, what the employee would do is that the employee will apply $1,000 of B's payment to A's account to cover the missing funds, right? And the remaining 500 from B is pocketed one more time, right? So later, if another customer, it could be customer A, B, or maybe a third customer who is paying, let's say 1,200. So now the employee applies the remaining 500 to B and 700 is pocketed. So are you following the trend here, right? That's the reason it's called lapping, because this employee is lapping or overlapping the cash from one customer and putting it on the other customer's account, right? So in a way, there is stealing which is happening, right? But it is really, so if you look from an overall perspective, it's really hard to catch this, right? It's really hard to notice or catch this lapping. So this is what lapping is, right? Now this is a continuous cycle, right? So later when customer A again pays, maybe, so right now A is already done, right? So A's account is perfect because we have applied everything to A. B was lagging, but once we got the third payment, this employee closed out the account for customer B, right? Right now, customer C is lagging, right? Because customer C paid 1200, but none of this that 1200 is applied to customer C yet, right? So at this point, right? So let's say this happened in January, this happened in February, this happened in March, just as an example, right? So let's say if the auditor is looking into the customer accounts, or maybe the auditor is sending out customer confirmation right at this point, then the auditor might notice it. Otherwise, right, come May or come April, obviously, then this customer got covered. Maybe another customer will pay something, then that payment will be applied to customer C, right? So it is a continuous cycle. It will continue until and unless somebody notices something, or let's say this employee, right, who is now responsible for custody and recording. So let's say this employee goes on a vacation and someone else covers for this person, right? Then lapping is something which might get caught, because maybe that other person is not a fraud, right? He or she is a genuine person who replaced this person because this employee went for a vacation. Then that person could discover lapping, right? So as a result of which, you will notice that every company will have certain holiday policy, right? I'm not saying it's just because to catch lapping, but that's a part of it, right? uh, every company will have some sort of rotational policy, some sort of mandatory vacation policy. One is obviously to make sure that the employee is not burned out and they're taking their time off, but then there are other reasons behind it as well, right? Any question on lapping? It's basically a rotating cycle of stolen and misapplied receipts from customer. That's what lapping is. Is it clear? Any question on lapping? Now, again, as I mentioned, that how would you detect it as an auditor, right? So if you are talking from an employer or from an auditor perspective, right? Obviously, the ways to detect is, or the ways to stop lapping, if the employer wants to stop it, right? Segregation of duty, right? Proper segregation of duty will definitely prevent lapping, right? Uh, Maybe independent reconciliation, right? So maybe even though there is no segregation of duty here, maybe somebody else is reconciling customer receipt, right? And customer accounts, right? So let's say if somebody is doing a monthly reconciliation or a quarterly reconciliation, right? Then this is something which might get caught, right? Uh, Again, from an auditor perspective, if the auditor is asking for a customer confirmation, right? Or an external confirmation, so that is something which can be handled, right? Some companies follow a logbox system, right? What is this logbox system? So instead of sending the payments to the to the company, the customer directly sends the payment to the bank. So there is no employee access, right? The customer will directly deposit the money in the bank instead of sending a check or sending some sort of payment to you uh, as a seller, right? So that's what logbox system is, right? So that is something which can prevent lapping as well if the funds is getting directly deposited in the bank. So again, things like deposit matching can also help, right? So here you're comparing the remittance advice with deposit slips, maybe on a weekly basis or on a monthly basis. Uh, Remittance advice we know, right? So something which comes with the check, and then that remittance advice is compared with the deposit slips which are getting recorded that okay, this is what we got from this customer, so these are my total receipts, and then these are the remittances which I have received from the customer, right? So if you compare those two, right, obviously if this employee is stealing money, that employee is not so, this customer paid 1,000, right? So the remittance advice will show 1,000, right? But since the employee did not deposit the money, so there is no deposit slip, right? Or check slip, right? You can call it anything. So obviously, if you're reconciling, there is obviously no deposit against this 1,000. So again, comparing or matching that will also help you discover lapping. Any question on lapping? Pretty simple, straightforward. Okay. The next concept when it comes to cash cycle is kiting. What is kiting? So let's say on December 31st, an employee writes a, let's say, $50,000 check from Bank A and deposits it in Bank B. So this client or this company, obviously many companies has more than one bank, right? Uh, so on December 31st, what this employee is doing in the company is that this employee is writing a $50,000 check from Bank A and deposits in Bank B, right? So obviously, since the check is written on 31st December, the check won't clear until January, maybe on January 2nd or 3rd, whatever, depending on the time when the check is written, right? So, what is happening here? Bank A doesn't show the cash out yet, right? You cut a check from Bank A to Bank B, but since the check won't get clear until January, right? So, as of December 31st, Bank A won't show any cash out, right? Because the check did not get clear, right? Bank B already shows the cash deposited, right? So, what is happening here? Are you following the concepts? What is happening? So, let's say Bank A 100,000, Bank B 50,000, right? Let's say Bank B before this transaction don't have any money, right? So when the employee is cutting a check or writing a check, right, in its books, so let's talk about books here, right? In its book, it will show that there is no cash out from this bank, right? But it will also show that 50,000 deposited in bank B. So it's not showing the cash out from bank A, but it's showing that, okay, we have deposited 50,000 in bank B. So the cash as of December 31st should be 100,000. However, the company is showing 150. They are using this kiting fraud, you can say, to show overstatement of cash at the end of the year, right? So what is happening here? This company is temporarily inflating the cash, right? And misleading the users of the financial statement, right? Are you following what is happening here? So writing a check from one bank and depositing it in the other bank right towards the year end, right? And then showing that, okay, the cash is not out from this bank yet because the check did not get clear. But then also showing that, hey, I have 50,000 of deposits in the other bank. Uh, how to detect it? How can you detect this? Yeah, bank recon, right? Or checking the bank transfer schedule, right? Or doing a cutoff testing for the bank statements, right? If you do a cutoff testing, right? Maybe if you take the bank statement towards the last week of December and towards the first week of January, if you see those two statements, then you will see that, okay, there has been a cash out on December 31st, but then that got deposited in the other bank in January, right? So obviously, then you will go back and say that, hey, you cannot show this deposit in bank B because you can only show this deposit in January. And then you also have to understate, or you also have to take out the deposit from bank A as well, right? So, yeah, that is something which would help you to look into, right? And obviously when you're looking into bank reconciliation or when you're performing a bank reconciliation, right, you're looking for checks in transit, right, that are not cleared, right? So that's what bank reconciliation is. uh, you look for the checks which are, whether it's a deposit or a payment, right? You look for checks which did not get, which are issued but not deposited, and then checks which are cut but not cleared yet, right? Any question on kiting? So those are the two concepts when it comes to your cash cycle, right? So again, if somebody asks you lapping, right, what lapping is doing to your books? It is misstating the accounts receivable, right? Right. In other words, it is overstating the accounts receivable, right? Isn't it? So if you go back to your lapping, customer A pays 1,000, but then that amount got stolen, right? So if you prepare a balance sheet after January, customer A will still show 1,000 on your balance sheet as accounts receivable, right? So this is overstatement of accounts receivable, right? So lapping could lead to misstating the AR, right? That means your accounts receivable is not reflected properly on your balance sheet, right? On the other hand, kiting will lead to overstatement of cash at year end, right? These two are temporary form of frauds, right? As I mentioned, this is a continuous cycle, but at some point this will get caught, right? How long can you continue this cycle? Maybe you can continue for a few months, maybe you can continue for a year or so, but eventually it will get caught, right? uh, and then obviously the same thing is for kiting as well, right? You are just doing it for a temporary period, right? You're just doing it for to look your balance sheet good for year end, but then eventually in January it it will clear, right? So these two are temporary kind of misstatement of frauds which can happen when it comes to cash. Any questions? Okay, that's a good question. Prachi is asking, does lapping still happens in real world, given the transactions are now digitalized and mostly transferred to bank? Yes, that's true. That's true. It is less common nowadays, right? Because of digitalization, right? But it hasn't been eliminated entirely. You can also do lapping through some sort of technology loopholes as well, right? Obviously, not every client is digitalized or not every company is digitalized, right? So you might come across a company who is still doing lapping. On the other hand, even if it's digitalized, right, there could be some sort of digital lapping tactics which somebody could do, right? They could manipulate that digitalization itself, right? So that is one of the control. Like if you have a logbox system where the checks are deposited directly into the bank, that's one way of preventing lapping for sure, right? So that's one of the control point. So if the auditor is auditing a client and the auditor is saying that okay, the client has a logbox system, right? So the client has a policy where the customer needs to pay directly to the bank, then the auditor will obviously judge that there should not be any lapping in this client. But yeah, nowadays it's less common for sure. Any questions on kiting and lapping? So when it comes to cash cycle, these are the two main things where you might get some questions in the exam. Okay. The other two important things when it comes to cash cycle is, and we kind of discussed that a little bit, what would be your audit procedure, right? What procedure would you perform to audit cash, right? So there are two very common procedures. One is your bank confirmation, right? What is bank confirmation? So they have given you a format. This is again, it will vary from bank to bank. But what are you doing here as an auditor? You are directly asking the bank, right, to confirm the balances across all the accounts, right? So if I have to zoom in. So in this letter, right, or in this format, what are all the details? So you have the accounts number, right? Balance, right? Due date, right? Interest rate. So if there is any loan, right? So they have to provide that entire detail of the loan, right? And then at the close of the business day, they will have all the account detail, name, what is the balance, if there is any interest associated with that or not, right? So this is a confirmation which you can request from the bank as an auditor. So this will not only provide you sufficient evidence on cash, it will also provide you evidences related to any long-term liability or any short-term loans which you have from the bank, right? It will tell you if the collateral is an asset, if it's accounts receivable, maybe you're selling off or pledging your accounts receivables, right, to get some loan from the bank, right? So then in that case your accounts receivable is pledged, so there is restriction on your accounts receivable. So it will not only give you detail on cash, it will also give you some other details. So this is a nice formatting, and this is standard format. This will vary, but this is something which you can request the bank to send you directly. Okay. On the other hand, what is the other most common thing you could do? You can do a or you can perform a bank reconciliation. Obviously, when I say you can perform, you as an auditor can also prepare a bank reconciliation, or you can review the bank reconciliation which has been prepared by the client itself, right? Now, you like there has been instances where the exam provided you like ask you some questions, whether it's an MCQ or a small task based simulation on bank reconciliation, right? uh, so obviously you have to like a very simple format, right? You start with, let's say you start with the bank statement balance, right? Then you deduct the outstanding checks, right? You add the deposit in transit, then you come up with your adjusted bank balance, right? On the other hand, if you are starting with company's book balance, right? So company's cash balance as per books, then you deduct bank service charges, maybe you will deduct some NSF check, maybe you add customer direct deposit, right? Then you come up with your adjusted book balance. So these are like typical formats or typical way of performing your bank reconciliation, right? So if there are any mismatches, then you will have some issues in the reconciliation itself. Uh, I think we have done a question, if I remember. I think we did a question on bank reconciliation. But again, this is something which is not new if you are already studying commerce, right? This is a very common thing which you have done before as well. Any questions? Nothing? Okay. All right. We can move on to the next cycle then. Again, when it comes to cash cycle, two important concepts: kiting, lapping, and then two main procedures which you can perform: bank confirmation and bank reconciliation, whether it could be reviewing it, requesting it, or maybe preparing a bank rec yourself. Auditing, again, these are all the common tropes which we have already talked about, like when we were discussing assertions, right? What would you do for completeness, right? What would you do for cutoff? What would you do for valuations? What would you do to test the existence, right? What would you do to check the presentation and disclosures, right? So when it comes to completeness, what would you do? What would you do to check the completeness assertions for a bank for a cash cycle? Anybody? If you remember, we kind of discussed this during revenue and expenditure cycle as well, right? You would do as an auditor, and this applies to all the cycles which we will discuss, right? So you have all those assertions, right? You have all those completeness, existence, valuation, right? If you remember when we talked about accounts receivable, right? If you want to check valuation for accounts receivable, obviously you have to check the allowance for bad debts, right? Uh, if you have to check fictitious sales, right? Maybe you would do a cutoff testing, right? Or you have to maybe look into the shipping documents to make sure that whatever is recorded is correct or not, right? To check the existence of accounts receivable, you will send out external confirmations, right? So those are some of the things which you should be doing as an auditor, right? On the other hand, when it comes to completeness for cash, right? What are you checking? You are checking that all cash transactions and balances that should be recorded are recorded, right? That's what you're checking when it comes to completeness. All cash transactions, since you're looking for cash completeness, right? That should be recorded are recorded, right? So what can you do to check this assertion or to test this assertion? Anybody wants to throw in some audit procedures? Apart from bank confirmation and reconciliation, as I said, that those are the two most common thing which you will do to test cash cycles. But what are something else? Anybody? What would you do to test valuation of cash? Yeah, those tracing vouching is fine. So when you talk about tracing or vouching, so those are the methods, right? But I'm asking what exactly would you do as an auditor? So let's say if you talk about valuation of cash, right? Maybe you would, if the company deals with a lot of foreign currency, right? So maybe you as an auditor, you will verify the foreign currency balances using appropriate exchange rate, right? Just to make sure that the valuation of cash is correct, right? Uh, when it comes to existence, like again, I'm asking apart from bank confirmation and reconciliation, what else you can do? So if you talk about existence, maybe you can say you are physically inspecting petty cash if material, right? So if there's a lot of petty cash or actual real cash which the client is holding, right? Maybe you would want to go and physically inspect those if they are material, right? For completeness, what you can do, you can do, yeah, Aditi is saying cut off, right? So you can trace the last receipts and disbursement before the year end to see whether they were recorded in the correct period or not, right? So for completeness, maybe you can do or you can trace the last receipts and disbursement before and after year end to see if they were recorded in the correct period or not, right? What else? What else could you do? Maybe you can look into the general ledger, right, for unusual or missing cash entries. That's something which you can do, right? What else comes to your mind? Taking high value transactions? Yeah, yeah, you could do that. You can flag the high value. When you say transactions, since we are focusing on cash, right? So maybe you can say if there are high value cash transactions, right, which is happening, you would want to check that, right? So what are the things which you could do? So if there are any high value cash transaction is happening, obviously you would want to see whether that has been discussed in the board or not. So maybe you can look for board of meeting notes, right? Board meeting notes, you can check that, because if a company is doing a high value cash transaction, they should have some sort of approval, or maybe they should have discussed it during their board meeting, right? So you can look into the board meeting notes. You can look for approval process, right? What is the threshold of approval of any high value transactions, right? Whether there is a policy or not, right? What else can you do? Anything else comes in your mind? What are some of the documents when we discussed about revenue and expenditure cycles, right? We talked about documents like sales order, purchase requisition, right? Shipping documents, voucher package, if you remember, like the treasurer have to cancel the voucher package once the payments are made to the vendors, right? Credit approval notes. Those were the different documents, right? Sales invoice, purchase invoice. What are some of the documents here in cash cycle? You have something called, as I mentioned, bank transfer schedule, right? Maybe you will look into remittance advice. Maybe you will look into deposit slips, right? Obviously, bank confirmation, right? Bank reconciliation, right? What else? What are some of the other terms which comes in your mind when it comes to cash or bank cycle? We discussed about this logbox system. If there is a logbox system or not, we have to know, right? Cash register, right? What else? Meeting notes, again, for high value transactions, right? Approval policy for high value transactions. Again, so these are some of your common documents which you will look for in a catch cycle. Cool. Yeah, petty cash, right? Physical petty cash verification. All right, we will move on. Before I move on to the other cycle, let us revise one of the things which we have discussed before also. And I just want to make sure that I discuss this in every class from now on. So when it comes to completeness, right? And when it comes to existence, can you tell me what are we testing here? What are we testing when we say completeness? No, I'm not asking specifically related to any cycle, but in general, what are we checking? Anybody? Anybody wants to? What are we checking for complete when we say completeness? What does it mean? Checking whether transaction has been recorded in ledger, right? So you are checking whether all transactions and balances that should be recorded are recorded, right? So all transaction and balances that should be recorded are recorded, right? So what is your focus point or concern point as an auditor? What is your focus or concern point? When you're testing for completeness, what is your focus or concern point as an auditor? What are you worried about as an auditor? All transaction and balances that should be recorded are recorded, right? So that should be recorded are recorded. So what are you checking for? Or what is your concern? Understatement, right? So your concern is you are worried that something is missing from the financial records, right? Something is missing from the financial records, right? So your concern is understatement, right? That is your concern, right? So if you are worried that something is missing from the financial records, right? So from where will you start? From where will you start looking for it? Will you start from your books or will you start from your source? You will start from, or you can say, source to books, right? Because if you're looking whether something is missing on your books, you cannot start from your books, right? Because your concern is that somebody did not record that in their books, right? So obviously you cannot start from the books. You have to start from the source and then trace it back, right? So then you're talking about tracing here, right? On the other hand, when it comes to existence, what are you testing? What does it mean? What do you mean by existence? Right? Or existence or occurrence is one and the same thing. Existence is for balances, occurrence is for transaction. So what do you mean by that? Everything recorded in the books actually exist, right? Or actually occurred, right? So that's what you are doing, right? So what is your focus or concern here, right? What is your focus? You're worried about what? You're worried that the company made something up or recorded something that doesn't exist, right? So the company has recorded something that doesn't actually exist, right? So your concern is overstatement, right? So what are you doing? You are looking for something which the company has already recorded and you're looking for whether that exists or not, right? So obviously in this case you will start from your book and then go to your source, right, to find the source, to find whether they exist or not, correct? So then you will do vouching, and this is something which, you know, you have to, like, this is something which is should be very automatic in your mind when it comes to these two, completeness and existence. So make sure you understand the concept, like what is your concern point, what are you exactly doing, and from where would you start. And again, as I mentioned this, so this is 95 to 99% of the time, right? Same for this, 95 to 99% of the time. There could be time when you have to do vouching when you are doing for completeness, but those are exceptional scenarios, right? But you can, for now, you can remember this like this. Okay, moving on to the next cycle, which is our inventory cycle. So when it comes to inventory cycle, what are you referring to, right? You are basically looking for the flow of goods and related transactions, right? So let's say if you're purchasing inventory, right? Right? Or if you are selling the inventory, right? So let's say if you're purchasing the inventory, what are the things which goes with it, right? You're purchasing it, that means you are receiving the inventory, you are storing the inventory, you are issuing the inventory to production or sale, right? Then you are shipping goods, right? If you are selling the inventory for sure, and then you are recording inventory and COGS, right? So obviously, when it comes to inventory, obviously you will purchase and then you will sell, or you will manufacture and you will sell, right? Regardless, if you are manufacturing, then obviously you have to purchase something, right? So then your raw materials would be your inventory, so you're purchasing raw material, right? You are storing the raw materials, you are converting that raw material into finished goods, right? Then you're shipping it, right? And at the end, you're recording all your inventory, right? On the other hand, if you are just a retail person, right, then you're just purchasing it, receiving it, storing it, issuing the inventory to production or sale, and then shipping the goods while you're selling it. And then at the end, again, recording your inventory and associated costs. So that's what the inventory cycle deals with, right? The flow of goods, whether it's raw material or your main inventory, if you're not a manufacturing unit, how you are dealing with that, right? So what are the accounts, or what are the key accounts involved here? If you talk about balance sheet, right, obviously we have inventory, right, as assets, right? What else you have on your balance sheet when it comes to inventory? You have accounts payable, right, as a liability on your balance sheet, because if you're purchasing it, obviously you have to pay to your vendors, right? So accounts payable is an important account. You can say it is associated with your inventory, right? What else? So from an income statement point of view, what are the accounts you should be focused on? COGS, right? So your cost of goods sold, right? Or your, if you're not a manufacturing company, maybe you can say purchases or freights, right? These are some of the accounts. And again, when you talk about inventory, it could be raw material, work in progress, finished goods, right? Depending on the type of company you are, right? Now, what are some of the key documents? What are some of the key documents you should be concerned about? Obviously, when you're dealing with purchase, right? So purchase requisition is something which we talked about in expenditure cycle as well, right? So what is this? This is your requisition or request to buy the inventory. As a company, if you are buying an inventory, it's not like you can just go in the market and buy. There has to be a formal procedure. Somebody has to raise that purchase requisition to buy that inventory, right? So that's the request to buy the inventory. Then you have your purchase order. This is something also we talked about in expenditure cycle, right? You are sending your authorization to the vendor, right? Then you have something called as a receiving report. What is this? You are confirming the inventory received, right? So if you remember in the expenditure cycle, like we mentioned that somebody who receives the inventory counts the inventory and then compares it with purchase order and then put that quantity. Obviously, that person won't have the quantity from the purchase order because that person gets a blind purchase order. If you remember, we talked about all that last week in our expenditure cycle. So then the receiving report gets issued. So that is also an important document in your inventory cycle, right? Then you have your vendor invoice, right? Since we also deal with accounts payable, so vendor invoice plays an important part. Then you have something called as an inventory ledger or tag sheet. What is this? This basically tracks the inventory quantity and location. So every inventory should have some sort of tracking mechanism associated with it, especially if you are a company who has maybe a lot of warehouses, right? So let's say let's talk about like an e-commerce company, whether it's Amazon, Flipkart, or whatever, right? So you have so many warehouses, correct? So maybe if you get an order and in nearby warehouse doesn't have that order, or doesn't have that inventory, maybe they have to request it from a different warehouse. So all your inventory should have some sort of tagging or tracking mechanism, right? Which should tell you the quantity and the location of your inventory so that it's easy for you to maneuver that inventory based on the requirement. Whether you have a requirement to sell that directly or whether you have a requirement of that inventory in your manufacturing process, right? Regardless, you need some sort of tracking mechanism for your inventory. And then you have something called your shipping document, which we have discussed in revenue cycle, which is bill of lading, right? So this is going, so you are sending out the inventory from your warehouse, right? So shipping out the inventory from warehouse, right? So that's also a part of your inventory cycle as well. So these are all your important or key documents when it comes to inventory cycle. Any questions so far? Any questions on any of these? We all know about all this. This is one of the new thing which we discussed, but everything else we know about it, these documents when we talked about revenue and expenditure cycle, correct? Vendor invoice is the invoice which you are getting from the vendor, right? So once you're ordering the inventory, right, and if you when you're receiving the goods, you also get an invoice from the vendor who billed you. So let's say if you ordered 1000 units of whatever, like food cables, for example, right, costing $400,000. I don't know. I just pull an example. So you will get an invoice. So it's just like the opposite of sales invoice, right? If you're selling 1000 units to somebody, you will raise a sales invoice, right? And you will send that invoice to that person. So for that person, it is a vendor invoice, right? Because that person is buying 1000 units from you, right? So that person is receiving a vendor invoice. So then you are a vendor. On the other hand, if you are selling, you are a seller. So this is just the opposite of sales invoice. So this is an invoice which lists you how much you owe, what are the things you have ordered, and what are the details for that item. Does that explains vendor invoice? Okay. So when you deal with inventory cycles, especially for the purpose of your CPA exam, there are two things which you should be aware of. One is, didn't they? Huh, that is weird. Anyways, okay. So one of the important thing is your inventory valuation methods, right? Since we are discussing US, so which are acceptable in your US cap, right? So For example, if you've heard about these, I think you have before, right? FIFO method, LIFO method, right? Weighted average, or you have some specific ID. So what are these things? I think, yeah, for when you study FAR, you will discuss this into more detail. Like there are actual questions or uh, details related to how you calculate all these valuations. So FIFO is, we know, first in first out, right? So recent inventory remains in the stock, right? So if you are, as a company, if you are following a FIFO method while valuating your inventory, that means that whatever inventory you have in your stock are the recent inventory, right? Because it's first in first out, right? So whatever you bought first, you're selling that first, right? So whatever you have in your stock, most likely that those inventory are your recent inventory. On the other hand, when it comes to LIFO, this is last in first out, right? So in this case, you can say recent inventory sold first, right? So whatever you have in stock, those are your old inventory. So old inventory remains in stock, right? On the other hand, when you talk about methods like weighted average, so this is basically your average cost per unit. You're valuing your inventory based on the average cost. And then when you talk about specific ID, these are used for some unique items, like, for example, a car, right, or a jewelry, right? These will carry some sort of unique item which will help you to identify the valuation of that specific car or specific jewelry. Uh, Thinking that there should be some sort of practical example in your book. There is not. Let me see. Okay, they have one which is related to your AGE, but they are doing adjusted entry, but this is not related to valuation. Okay, so they are just talking about that here a little bit. Uh, Nowhere else they are mentioning. Interesting. Anyways, we can do a very straightforward examples. Let us talk about FIFO first. For those maybe who are not aware of how you're valuing. So let's say you have purchased 100 units at $10, right? So this is, maybe you have purchased this in, let's say, January, okay? And then again in March, you have purchased another 100 units at $12, right? So this is $1,000 and this is your $1,200, right? What is the total available units you have? Total available units. You have 200 units. Okay. So let's say in April, you are selling, right? So let's say you are selling 120 units. Okay. So 54 tells you sells the oldest unit first, right? So then you will first take down the 100 units at $10. So again, let's say at the end of March, your inventory has 200 units with a value of 2,200. This is something which you are recording on balance sheet as of March. Okay. Now in April, you're selling 120 units, right? So if you're following FIFO, you will sell the first units, like first 100 units at 10. Obviously, your sell price will be more than 10, but from an inventory perspective, right? So when you record sales, obviously you record your cash or accounts. What is your entry? Debit, accounts receivable, credit. Can you tell me? Inventory, right? What is the other credit? So if you're selling 100 units at 1,000, you will credit the $1,000 of inventory, right? Maybe you're selling at 12 per unit, right? So you will debit how much? Maybe 1,200. What is the other? What is the other credit? What is the other credit you will do? Or to simplify it, if let's say you're selling it for 1,200, right? So let's say you are crediting revenue 1,200, right? On the other hand, you are debiting COGS, right? You're debiting COGS for how much? 1,000, right? Then you're crediting your inventory, right? For 1,000. So obviously, at the end of the day, you're recording if you look from an income statement perspective, right? On your income statement, you have a revenue of 1,200 and you have a COGS of 1,000. So your profit is 200, right? That's what you're recording. So again, going away with the journal entry, let's say you're selling 120 units. So how much you will write down your inventory? If you are following a FIFO, you will write it down the first 1,000. You write down the first 1,000 first, right? And then for the remaining 20 units, you will take down the next lot of your inventory, right? Correct. So how much you will take down here? You will take down 240, right? So then you have 1,240. So at the end of April, right? End of April, you will have how much of remaining units? 80 units, right? And what will be the remaining value of your inventory? Right. So this is on balance sheet as of April. So that's what FIFO is. So let us copy the same example and do a LIFO, right? Let's say you are buying the same inventories, right? But when you're selling, you're following a LIFO, right? So then you will sell the 100 units at 12, right? So this will be 1,200, and then the remaining unit will be sold at 10. So then you will have 200 here. So then you're saying that your ending inventory is different, right? So you still have 80 units in both the cases, correct? But then when you're doing LIFO versus FIFO, your ending inventory is changing, correct? So in this case, we saw an increase in price, right? We saw an increase in price. First, we bought it at $10 a unit, then we bought it at $12 a unit, correct? On the other hand, you are selling at FIFO, right? So what is happening here? What is happening? What is happening? Can you tell me? If you compare these two methods and there is a trend in increase in prices, so prices are rising over time, right? So for FIFO, what is happening? You are selling the cheapest inventory first, right? So more expensive inventory is staying on your books, right? So if I have to ask you some questions, could you tell me the impact on financial statement for increasing prices, right? So let's say if the trend is prices are rising over time, right? What is the impact you will have? If you talk about COGS, right? What is the impact here? Old costs used, right? Net income high due to lower COGS, right? Old cost, which is low, that is used. So your net income is high because your COGS is low, right? And then your ending inventory is high, right? Because new items with higher cost remains on balance sheet. Are you following this? Are you following this impact? On the other hand, if you do a LIFO, what would be the impact when the prices are rising, right? Then your COGS, you're using the new costs, right? So your COGS is high, your net income becomes low due to higher cost of goods sold, right? And your ending inventory will be low because the older or cheaper items remains on balance sheet, right? Correct. So that's one of the relationship which at times you might get question on this type of relationship between the valuation methods. Any question on these two, right? If you make this opposite, if you say that, okay, what if the prices are decreasing over time, right? Then you will have an opposite impact, right? If the prices are decreasing, then you will have an opposite impact of whatever we have talked about right now. Okay. The other hand, let's talk about the weighted one. So what if you have a weighted average? what happens? Let's say you're buying the same things, right? But since you're doing a weighted average, when at the end of the March, you are recording your inventory, you will say that, okay, I have 2,200 units, 2,200 value worth of 200 units. So basically, your per unit value is $11. So this is per unit value, right? So when you are selling it in April, you're selling 120 units, so you will do 120 units at the rate of $11, right? So then 120 multiplied by 11, so that would be your COGS, right? So this won't be applicable because you're using weighted average, right? So then you are remaining with your 80 units at 880, right? The cost per unit still remains same, right? So that's your weighted average method. Any question? Okay, moving on then. And again, another thing which you will hear a lot is your net realizable value, right? So that's the cost method which we are discussing, LIFO, FIFO, and weighted average. And then you have a valuation method as well, which could be your NRV or lower of cost or market. So what is NRV basically? Anybody knows about NRV? So let's say, and I'm not exactly sure whether this is applicable in your audit, but definitely we'll talk about this in FAR when you study FAR. But just to give you a basic idea, so your NRV is basically your estimated selling price minus cost to complete and sell, right? So it is basically the net amount which you are expecting to realize from the sale of inventory. That's what NRV is, right? So let's say your estimated selling price for an inventory is $100, right? And your estimated cost to complete and sell that inventory, let's say, is $15, right? So your NRV is 100 minus 15, right? So $85, right? So that's what your net realizable value is, right? So you're using a valuation method. So excuse me. So you are using your valuation method, right? For, and again, when you talk about NRV, it only applies to your FIFO or weighted average, right? Uh, Under LIFO, there is something which is called your LCM or lower of cost or market, right? Uh-huh. So there is a concept called flooring and ceiling. I'm not sure whether your audit exam is concerned about all this. So we won't go into detail, but LCM is only applicable for GAAP, right? In IFRS, you don't use LCM. But the reason you will study LCM in FAR because you are obviously dealing with US GAAP, right? You're not studying IFRS. Uh, Again, I won't go into that detail, but just to give you an idea, so we discussed the cost method, but then there is also a valuation method at which you can value your inventory, whether it could be NRV or whether it could be LCM. Uh, Focusing on audit or coming back to audit, what should be your focus points, right? We talked about this a lot, existence, right? When you're auditing inventory, existence is something which you should be concerned about, right? So, overstated balance, how you will confirm existence? Obviously, you will do physical verification, right? Whether you will be doing it yourself or whether you will be observing the physical inventory count, right? So, that is one of your key procedure and key assertion to test for your inventory, right? Another one is your valuation, as we have talked about, right? So obviously you have to know whether there are obsolete inventory lying in the warehouse or not, right? So while you're doing your physical verification, right, if you observe some old inventory lying in the warehouse, you might ask the question that, hey, are you showing this inventory on your balance sheet? If yes, at what valuation are you showing them, right? Are you valuing this old inventory at the current rate, or are you using some other valuation method? Because I don't think these inventories are sellable in the market. So maybe you should write off that inventory, right? So if you're showing $100 as an inventory, and if I notice that there is $20 inventory which is obsolete, I should tell the client to write off that inventory from their balance sheet, because I don't think that they will be sellable in the market anymore. So again, valuation, you have to observe, you have to know whether there is any obsolete inventory lying in the warehouse or not. And the third thing which we haven't discussed before is related to your right and obligation. So this is something which gets tested quite often in your audit. This is related to your consignment inventory. So what does that mean? What is consignment inventory? So what you are doing as a like as a business is that one party, so that party is called the consigner, right? So this party sends goods to another party who is the consignee to sell on their behalf. So consigner is sending inventory to the consignee to send on the behalf of the consigner, right? So let's say the consigner is your client, right? And if your client is sending inventory to the consignee to sell on consigner's behalf, right? What does that mean? That doesn't mean anything, because ownership doesn't get transferred until goods are sold to a third party, barring some specific consignment agreement, right? Let's say there is no specific agreement related to the consignment, right? Your client has transferred some inventory to the consignee to sell, right? But then the client can't consider that as sales until those inventories are sold by the consignee, right? So the mere transfer of inventory from the client's place to the consignee doesn't means that those are sold, right? Until and unless there are some specific agreement. So let's say there could be some agreement in the consignment agreement itself where the consignee will say that, hey, you can send me the inventory, you can record that as sales in your books, right? I will take the full responsibility to sell it on, like in that case it's my full responsibility to sell, right? So the moment you are transferring the inventory to me, you record it as sales, I will pay you the money, and then it's up to me how I am dealing with that inventory. In that case ownership did transfer, right? You don't own that inventory anymore, right? Because you are recording it at sales based on the consignment agreement that you have with the consignee. But under most scenarios, that's not what happens. You basically take your inventory, transfer it to somebody else to sell your on your behalf. But until and unless they are selling it, you are not recognizing any revenue or any sales, right? So this is one of the important area where you as an auditor, you need to be cognizant about, right? So so let's say company A is the consigner, right? So let's say when inventory is shipped to the consignee, right? Tell me the journal entry which you will record. When the inventory is shipped to the consignee, will you record any journal entry? No, right? No journal entry is recorded, right? Is just a memo or footnote based on what kind of documentation you are maintaining, right? But now, let's say when the consignee sells the inventory, right? Then you will record your debit cash or AR, and then you will credit the revenue, right? And you will record the COGS and credit the inventory, right? You will record this when the consignee sells the inventory, not when you are transferring the inventory to the consignee. On the other hand, let's say company B is the consignee, right? So receiving inventory from company A, will you record anything? Let's say this is your client, you are auditing company B, right? Would you expect to see any recording when this is happening? If company B is receiving the inventory from company A, no recording, right? No J is recorded, right? No inventory. The consignee cannot record that inventory on their balance sheet, right? Because it's not their inventory, it's just the inventory which they are holding on the consignor's behalf, right? Now, when consignee sells the inventory, what JE you will record? Will you record a JE? When you are selling the inventory as a consignee, will you record anything? No, right? You won't record the sales, but obviously you are taking up this consignment to earn some sort of commission, right? So the only thing which you will record is your debit cash or bank and credit your commission, right? Commission revenue, right? Either you will record this, or in some consignment, what could happen is that since you are selling on behalf of company A, so maybe you will receive the cash or yourself, right? Let's say if you're selling on cash, so maybe you will receive cash, let's say you sold it for 50,000, right? So you receive cash, then you can credit something called as a payable to consignor, right? Maybe your commission will credit as well. So maybe 2,000 is your commission, and then the remaining amount is something which you have to pay back to the consignor, which is company A, right? So, and then once you're paying it back, then they are recognizing this revenue and then they are putting it out of their inventory. So there could be either this entry or there could be an entry like this. It depends. Okay. Any question on this? Okay, if not, I will take a 5 minutes break and then we'll come back. Okay, let's continue. Investment cycle. What are we dealing with here? So most of the company will be investing their money into some sort of acquisition, some holdings, uh, maybe they are disposing of their long-term assets, right? So mostly this is dealing with your marketable securities, right? Maybe stocks, bonds, ETFs, etc., right? Then some sort of derivatives. It could be options, futures, swaps, or whatever, right? Then investment in subsidiaries, right? So there are two types of investments. And then again, this is something you will learn in detail in FAR. So equity method or consolidation, right? And then you have other long-term financial instruments or whatnot. So again, we'll focus mainly from the perspective of an auditor. So whenever you have some sort of investment, right? What are the key accounts involved into that? So let's say you're talking about a stock bond investment, right? Whether it's a short term or long term, right? Your balance sheet will have an impact on that, right? Then if you're receiving some sort of dividend and interest income, right, which is your return from investment, right, your income statement will have an impact on this, right? If you have any unrealized gain or loss, right, then this is something which will have an impact on either on your balance sheet or income statement, depending what you're dealing with, right? Depending on the, again, there are a lot of rules related to your available for sale security. We won't go into that detail, but based on the rule, whether you will impact your OCI or income statement. If you're impacting your OCI, then it's going to your balance sheet. If you're impacting your income statement, then it will go to your income statement, right? Then you have your realized gain or loss. Obviously this will have an impact on your income statement, right? Then, as I mentioned, if you have your investment in subsidiary, right, then also it will have an impact on your balance sheet. So these are all the key accounts which are involved, right? So here I'll just scan through it whether they talk in detail. Well, they're talking a little bit about equity method here. Hmm. Okay, they're not talking into detail about that. So I think I saw a question related to equity method and some journal entries. So I will find that and then we can do a question at EBS where we'll talk into some of the specific of what is your available for sale security, right? What do you mean by an equity method investment, right? What do you mean by a consolidation method investment, right? But to give you an overall view, like let's say if you are classifying it, again, we are talking from a US GAAP perspective. We are not talking from an IFRS or anything else. Uh, so if you're dealing with a trading security, right, your initial recording should be at fair value, right? So when you're recording something as trading securities, right, your initial recording should be at your fair market value, and then you have a subsequent measurement for fair market value each period. Then if you're dealing with something called as available for sale securities, right? So this is again your initially you will record in your fair value, then fair value each period, but this will go to your OCI under your balance sheet. If you're dealing with something else held to maturity, right? So you are, so what does, again, just to explain very simply, available for sale security is something which you are investing in, right? But you have the intention to sell it in the future, right? So that's your available for sale. Held to maturity is you're investing in something which you want to hold it till it matures, right? So if the maturity period is 10 years or 20 years, your intention is to hold the investment till it reaches its maturity, right? So then you will record it in amortized cost. No fair value adjustment is required. Uh, on the other hand, if you're talking about an equity method investment, right, then your recording will be cost plus the percentage which you are earning, right? So let's say you invested 20% or let's say 15% of your money in buying stocks in, let's say, OpenAI, right? So let's say Microsoft, well, that's a very on the face example, but let's say you have a company, right? Or you're dealing with a client who has invested 15% to buy some stocks in an emerging AI company, right? How would you treat that? How would you treat that investment? Any idea? How will you treat that investment? You will just treat that, you will measure it at fair market value each period, right? So mostly you will treat that either as a trading security or available for sale security, depending on what your intention is, right? But let's say if you're investing or if you're buying somewhere between 20 to 50%, right, of stocks in OpenAI, that means in this case, you have a significant influence on this company, right? The moment you're buying anything which is 20% or more, you have some sort of significant influence in that company. So that means you have to follow equity method, right? So what is the equity method investment? So when you are initially investing this money, right? So then you are recording this investment in open AI, and then you're crediting maybe cash, right? So let's say you invested $60,000, right? Let's say you invested $60,000. So that is your initial investment, right? But since this 60,000 equates to maybe 20%, so you need to follow an equity method, right? So you're recording the purchase at cost on your balance sheet, right? Now let's say this OpenAI earns 50,000 as net income during the year. Okay. So maybe you invested in January and then this company's earning 50,000 as net income. So since you have invested 20%, what you will do, you will recognize 20% of the investee income on your balance sheet. So now you will debit your investment in OpenAI, right? You will debit 20% of the earnings, so 50,000 multiplied by 20%. And then you will credit something called as a equity in earnings, right? So this is your 10,000, right? So what is happening to your balance sheet? Anybody? What is happening your balance in your balance sheet? What is happening to your balance sheet? You're increasing, right? So your initial investment at cost is 60,000 and you're increasing based on the investee's earnings. So that's why you call it an equity method, right? Because you are adjusting your investment based on the earning which this company is making, right? And on the other hand, you are recognizing this as income, right? So this is obviously an income statement item, right? So that's what the equity method of investment stands for. Let's say so OpenAI, let's say they also gives dividend, right? So let's say you receive maybe let's say 5,000 in dividends, right? So what does that mean? It will reduce. So what you will do, you will debit cash for 5,000 and then you will credit investment in OpenAI. So you will reduce the investment by 5,000. So yeah, if I have to say that this is something which you have done in January, maybe this happened in December, this also happened in December, right? So if I tell you what is the ending investment in OpenAI balance on your balance sheet, so then you will say, okay, the first 60, which I have increased the earning by 10,000 and I have reduced the earning by the dividend which I am receiving, right? So on my balance sheet, I will have 65,000 of investment in OpenAI at the end of the year. So that's what your equity method of investment, like that's how you treat it like this. Now, what is the reason behind this? And again, I'm diving into far a little bit more here. But what is this significant influence? So this means, so the moment you are owning something which is as big as a 20 to 50%, right, of any company, that means you might have, or you not might, you will have the influence to direct the company into something, right? So as a result of which, if you have a significant influence, you have to treat that company's investment as an equity. So there could be some question which will tell you that maybe company A invests, let's say $1 million in company B, which is 17%, right? So right off the bat, you will think that okay, in this case, this is not an equity method investment, right? However, if the question tells you 17%, but company A has significant influence, right? So the moment, even if it's not between 20 to 50%, but if the question tells you explicitly that this company has a significant influence, then you have to treat that investment as an equity method investment. right? So that's what it is. Any question on this? And if it's not an equity method, so let's say in this example, you are investing 17%, right? Maybe the amount is $50,000, right? And the question doesn't tell you specifically that it's a significant influence, right? So you will, what method you will do? You will basically do a fair value method, right? Fair value method of accounting. Mhm. So you will initially record this investment as cost, and then at the end of the year, if you're so basically what you will do, investment in open AI, maybe you, so this is your cost, right? So you record 50,000, you credit cash for 50,000, right? So this might happen in January, and then at the end of the December, let's say the fair market value of this investment has gone up. So there is a change in fair market value. Now, how would you know that the fair market value has changed, right? If this investment is traded in the market, right? So if OpenAI is trading in the market, then obviously you will know, right? Depending on the stock value, right? So if your $50,000 consists of 100 stocks, right? Then it's very easy for you at the end of December, depending on whether the stock went up or went down, you have to adjust your investment, right? So then you will say investment in OpenAI. Maybe the stock went up, so maybe your investment went up by 2,000. So then you will debit this 2,000, and then you will credit the unrealized gain for 2,000 because you did not sell it yet, but you will mark it up. So you will mark this 50,000 by 2,000, right? You mark it up to your fair value. On the other hand, if the stock went down, you will mark it down, right? But what if the investment is not traded in the market, right? So again, this is, let's say this is a marketable security. So it's very easy for you to look into the fair market value based on whatever at whatever price this is getting traded in the market. But let's say you don't have that visibility, this is not a trading security, right? Then how you will measure the fair market value? The other way for you to look into different, like similar stocks, maybe similar AI stocks in active market, right? So maybe you can look through. So again, there are different levels to which you can measure the fair market value. So again, there is a specific ASC 820 which deals with this. So your level 1 is your quoted prices in active market. Then your level 2 is your other observable inputs, maybe quoted prices for similar assets, right? And then your level 3 is your unobservable inputs, could be based on some modeling, could be based on some estimates, right? So again, if this is not getting traded in the market, and I think in your book they have this, I think I saw it somewhere. Yeah. So certain financial assets of liability are presented or disclosed at fair value, right? Fair value is defined. Now you have a 3-level hierarchy, as I mentioned, right? Level 1 level 2, level 3. So obviously, if quoted prices are not available, right, then you have to follow like some sort of estimates from a broker or any other party valuation model or whatever that is, right? So let's say if you're auditing, now we'll talk from an auditor perspective, right? So let's say you're auditing a client which has an investment which is not marketly traded, right? So then you have to look into what valuation or what level they are using to measure the fair market value of that security, right? So you have to look into that as an auditor, and you have to make sure that which level are they using. So if they are using level 3, right, what does that mean? That means that there could be some risk associated with it, right? This is, again, if you are talking, now we'll go into the assertions a little bit, right? When it comes to assertion, valuation assertion is one of the important assertion in investment cycle, right? So obviously, if you have a scenario like this is your most risky thing, right? A risky area. This is something you want to look into as an auditor. Like if this security is not traded actively in the market, what valuation are they using? If they are using a level 3 valuation, then maybe I have a higher risk, right? Risk is high, right? Because as I mentioned, level 3 is what? You are using some sort of third party modeling or maybe some estimates, right? So whenever it comes to estimate, you have to make sure that you check with the management, right? On what type of estimates they are using. So this is what it's talk about from an auditor's responsibility point of view, right? You have to understand the process on how they are determining it, right? And then from where they're getting that estimate, right? Consider the need, whether you need a specialist who deals with these type of valuations, right? Whether you would need some help from them to evaluate whether the fair market value is accurate or not, or if there is any management bias related to the fair market value. Maybe management is using some sort of third party estimate which is helping them to increase their initial investment of 50,000 to maybe another 10,000 at the end of the year, right? Maybe they are using some sort of third party valuation model, right? So you have to know that as an auditor, and you have to make sure that those are something which are properly vetted. You have properly audited that method which they are using. So that's your fair market value, and that's one of the thing which you should be concerned about when it comes to investment cycle. The other thing which you should be concerned about, so when we talked about the equity method investment, right? So in your equity method investment, as I mentioned that OpenAI earns 50,000, so you are recording this 10,000 of earnings, right? If you're following equity method. So as an auditor, the way you can audit this is you can ask OpenAI for their financial statement, and then you can look into OpenAI's financial statement to see whether they have actually earned 50,000 or not during the year, right? So that what this is telling you, when valuation are based on the investees financial results, right? So you can then opt in and read the financial statement. If they are audited, maybe you should read the auditor's report as well, and make sure that your client is recording their investment properly based on the other company's financial statement. So again, the main focus point is valuation. What are the different things you could do? You could do the fair market value methods. You can look into what level they are using, whether those are proper or not. You could look into other companies financials. You can look into the market, right? If the security which they are investing in is actively traded in the market, you can look into that as well. So that's about your investment cycle. Again, they're talking about completeness. Like in every cycle, obviously, they will talk about all these assertions for sure. but I'm just focusing on the main assertion related to investments. But again, all the remaining assertion is kind of same, right? So let's say if you are looking into completeness, right, what should you do? You should perform analytical procedure testing the reasonableness of dividend and interest income, right? So if the client is recording a dividend or interest income, right, you might do some sort of analytical procedure to see whether those income and dividend are the income and dividend which actually should have been recorded, right? So again, source to books, right? So what is your source? Maybe if you're recording an interest income, look into the source, look into like whether there has been some sort of interest rate, right? Whether there has been some sort of covenant related to the investment, right? From where you're recording that interest, whether there has been some dividend declaration from the other client, or you can also perform analytical procedure, right? So let's say you don't have that data readily available, you can look into last year's investment, right? And then you can see how much of interest was recorded last year. Accordingly, you can see whether the investment has grown or not. If yes, did the interest grow or not, right? So those kind of analytical procedure is something which you can do when it comes to investment. What are some other things? Cutoff. We already know cutoff, right? You have to look into whether the investment income which you're recording has been occurred in the correct period or not. Uh, Presentation and classification. As I mentioned, there are different types, right? You have unrealized gains on available for sale, you have realized gain, you have unrealized gain on equity. So you have to make sure that those are classified. So as I mentioned, any unrealized gain on available for sale security, right, it should be going to your OCI, right? It should not, you should not record that on your income statement, right? So that is something which you have to know or you have to look into as an auditor. So that's your classification part, right? Whether the securities are classified properly, right? If there is a equity method investment, whether they have classified it as equity method or not, right? Whether they are doing this equity method recording properly or not. So that's what you have to look into as an auditor as well. Again, as I mentioned, valuation is the most important thing which you have to look into. So here they are kind of categorizing it into transactions and then they're categorizing it into presentation and disclosure. It's one and the same thing. Any questions on investment cycle? These are nothing, as I mentioned, that you can use, so the client can use any pricing information from third party, right? So if that is happening, right, you have to make sure that they are using proprietary models, right? uh, you should understand the reliability and interdependency of that model. If they are using the quote from a broker or dealer, right, then you should consider whether the quote is timely or not, right? Whether it is reflective of the actual market condition or not, right? Is just because a broker gave the client a quote and based on that quote, the client is recording the fair market value on their investment doesn't mean that the quote is correct, right? You still have to know that whether the quote is reflective of the actual market scenario or not. If the current market is falling, if the current market is down, but on the other hand, based on the broker's quote, the client is recording another 10,000 increase in their investment just because the broker told them to do so, that's not reflective of the actual market, right? So then you have to know that as an auditor, right? And then last is your impairment indication. So this is, so let's say if a company holds bond, maybe the bonds were purchased at $100,000, right? And now the bonds are worth 70,000 right now. Maybe the bonds were purchased last year. Now the worth of those bond was 70,000. And the issuer of that bond was downgraded to a junk status. So what does that mean? That the issuer who issued the bond has no, like, technically you don't have any expected recovery of that bond anymore because the issuer got downgraded, right? So there are like a lot of ratings which could happen. I don't know whether they talk about that here or not. Okay, the security has been downgraded by a rating agency. So obviously each security will have some sort of ratings, right? So if the rating has been downgraded to some, I mean, I said junk status means it has been downgraded below, to a very bad state where you can say that okay, you can't recover this bond anymore, right? So then as an auditor you should evaluate whether this loss is temporary or whether, so let's say the rating has been downgraded, right? So now the bond is worth 70,000, right? So as an auditor you should know whether this 30,000 loss is temporary or the client should record a 30,000 impairment loss in their income statement or not, right? So that's something you got to know. Maybe this got purchased in January of 2024 and or maybe January of 2023, whatever that could be. I mean, just take a year. And now this is the condition as of Q3. You should be knowing whether you can record this as an impairment or not. So those are some of the indications. What are some of the indications? Let's say the fair market value dropped significantly of an investment, right? Maybe, as I mentioned, there has been a downgraded in the rating, right? Maybe the financial condition of the issuer of that security has deteriorated, right? Uh, there could be decline due to some specific condition. Maybe the issuer is involved into some sort of, maybe a scandal, or some, maybe a reputational hit, right? So maybe you bought a stock and then that company got a reputational hit. So those are some of the indications for you to look into the valuation and see whether an impairment loss should be recorded or not. Because impairment loss is what? When there is a decline in the fair market value, right? And if it's not temporary, if it's temporary because the market is moving, right? So it could be a temporary thing. If not, then you should evaluate whether you should be recording that or not, right? So that's about the indication related to impairment. Any question? Okay. No questions? Does it make all sense? All these cycles are making sense to you? Again, when it comes to investment cycle, your focus point should be valuation. So that's something which is super important. When it comes to inventory cycle, again, your focus point is valuation, and then you have another focus point related to your consignment, right? Uh, Existence and valuation. Those are two focus point when it comes to your inventory cycle. Even though I'm saying these are the focus points, all the other assertions also applies, right? Your completeness, your existence, your cutoff, your rights and obligation, all those applies to each cycle. But one of the focus point for inventory is your valuation existence. One of the focus point for investment is your valuation, right? Uh, One of the focus point for your revenue cycle or cash cycle. For cash cycle, I will say your obviously your existence is one of the focus point, right? Then same for your revenue cycle, right? Existence should be one of the focus point. Valuation, like whether you're valuing the accounts receivable properly or not, that could be one of the focus point. When it comes to your expenditure cycle, then you will have your completeness as one of the focus point, right? Are you understating any of your accounts payable, right? uh, Rights and obligation could be some of your focus points. So again, these are focus points, but as an auditor you should know each and every assertion. Like, you should first of all know the cycle, and then you should know what are the challenges in each of those cycle, right? For cash cycle, as I mentioned, the two challenges are lapping and kiting, right? And then what are the different methods you could use for cash cycle? Bank confirmation and your bank reconciliation are those are the two main methods you could use as an auditor. For inventory cycle, your physical verification, right? That's one of the most important method you could use as an auditor, right? When it comes to investment cycle, like to make sure that the fair market value which has been used is proper, right? Whether there is a need for any impairment or not, right? You have to be aware of the classification of investment, right? Whether it's equity method, right? Whether it's available for sale. If it's available for sale, then you have to make sure that their unrealized gain and loss is recorded in OCI and not income statement, right? On the other hand, if it's available for sale and there is an indication of impairment, right? Then you have to look into it to see that whether you want to mark it down, right? Excuse me. Mark it down. So if it's available for sale, again, the markdown will be recorded in OCI. But if it's equity method investment, right? And if you are seeing that there are some impairment indication, maybe you invested amount in your OpenAI, but the OpenAI maybe they hit their reputation got hit, right? So now the question is, should you record some sort of impairment on your balance sheet, right? Should you mark down your 50,000 by 30,000 or not? uh, if yes, then maybe you have to record an impairment loss on your balance sheet. So again, things like that you have to be aware as an auditor when it comes to all these different cycles. With that, we'll conclude the class today. Tomorrow, we'll continue with some other transaction cycles. And these are like mainly three, I would say. One is your plant, property, and equipment. The next one is your payroll. And the third one is your financing cycle. So this deals with debt equity. Payroll is payroll. We all know PP&E deals with your fixed assets, right? Whatever you're buying. Uh, we'll do that tomorrow, and then we'll do a task based simulation tomorrow as well, because this chapter should be very quick. These three cycles are very straightforward, very easy, so we'll be able to cover that tomorrow. All right, with that, that's all. I know I went overboard a little bit. Sorry about that, but we'll talk again tomorrow. Thank you for attending.